You can now say that as we introduced that this topic deals with the concept of raising funds. It deals with the concept of raising funds. This topic deals with the concept of raising funds. This topic deals with the concept of raising funds. This topic deals with the concept of raising funds by an organization. The topic deals with the concept of raising funds by an organization. The concept deals with the concept, the topic deals with the concept of raising funds by an organization. So we have different sources of capital. So let's talk about the source of capital. The first source of capital is normally equity. And on equity, this is from the shares, the members' contribution or the directors' contribution. Then we have debts. And then we have preference shares. Preference shares. Preference shares. Now, what is cost of capital? When you talk about cost of capital, what are we referring to? Cost of capital, what are we referring to? You can say that cost of capital is the cost of acquiring various sources of capital or various types of capital. Various types of capital. Various types of capital or sources of capital. Then the first one is cost of equity. So we look at the cost of equity. The first one is, we start with the cost of equity. When you are looking at the cost, whenever we take a loan, you normally pay loan with interest, right? So if you go to Shylock or to the bank, get a loan, you will pay loan back, fine. Your loan unarudisha tu, lakini sasa the cost of getting that loan is the interest that you're paying on return. So normally, how do we calculate the cost of debt or loan? We normally say interest on debt, which is the cost of debt, interest, which is the cost of debt, is equal to debt times the interest rate, right? That will give you the interest. What about when you are talking about equity, shares, share capital? What do you get in return? This is a share capital. So this one we talk about dividends. Is equal to share capital times dividend rate or return on dividends. Now, from this formula, when we are looking for the return is the cost. Like here, when you deposit in the bank, the interest income will be the return. It is the amount of the deposit times the rate of return. If it is a loan, the interest expense will be the cost. So the cost can be a return in some cases. Whatever is a cost to you can be an income to me. Depends on who is giving and who is paying. When you are paying dividends, the person you are paying to considers it as income, but to you, it is an expense. Right? It is a cost. It is a cost to you. But the person receiving it is an income. So therefore, what we are going to look at, sometimes we call it the cost of capital or the rate of return. They basically means the same. It depends on what you're doing. Are we referring to an income or we are referring to investment? So we're looking at the cost of acquiring the investment. Now, I want you to say that there are, after this, you say that there are two types of equity. There are two types of equity. There are two types of equity. Number one, A is retained earnings. Retained earnings. Two types of equity. A is retained earnings. And then B, A is retained earnings, and then B is ordinary share capital. Ordinary share capital. Those are types of equity. Whenever you get an income or a profit from your investment, you can pay yourself dividend as a return. But if you decide to plow it back, it becomes part of the capital. It is a source of capital. And of course, it is just for the owner, the same way equity, which is the ordinary share capital, is also for the owner. Retained earnings is also for the owner. So investors can decide, instead of taking everything home, they return back and invest. Therefore, being that the owner is the same, the ordinary and equity, the owners are the same. Being that they are the same, they are not going to source it from outside. They are going to retain it within. Now, from this formula of dividends, we can now say that, let's call the value of shares that you are going to get the share capital is normally price per share, which you can call BO, times the number of shares. So if you want to know the value that you have invested, is basically, if it is 10 more per share times 10 or 1 million, you know that you have a total of 10 million. So we are referring to 10 million as your share capital. So our dividend will be a percentage of this. All right. If the price per share is 10 shillings and we have total number of shares, 1 million, then we are talking about an investment worth 10 million. So the dividend will be a percentage of this. Now, if it is in total, we can also have dividends given as dividends, the rate of return on dividends or return on dividends. So dividend per share, we call it DO. So DO is the dividend per share. So if you want to know the total, is number of dividend per share times number of shares. Dividends is declared per share. So if you are asking those who have invested, they will tell you how much did you pay this year. Today we were given 2 shillings for every share. That 2 shillings is the dividend. Or they will say that last year we were given 3 bob for every share. That was the return in terms of money. Therefore, our total dividends here is the DO, that is the dividend per share, times number of shares. The value that we placed was the price of the share, so it is P per share, that is the price per share, times the number of shares. One thing that you can see is common here is that we are having shares in both of them. So we can decide to cancel and just do away with the shares. For example, we say that dividend, total dividends, is equal to share capital, which is now share capital is P times number of shares.
Excuse me,
Yes.
I'm not able to see the screen. Or is my phone only?
You're not able to?
I'm not able to see the screen. I can just hear the voice. Ama ni simu yangu.
Is there anybody who can see the screen?
Yes.
So kindly log out and log in if you have a problem with your machine, your laptop, or phone. Okay. So I was saying, are you able to see now, Faith?
Yes.
So what I was saying is that for us to get the total, in terms of total, it is the share price, that is price of one share, that is the number of shares they will give us the total investment, which we need to get return on. When we are talking about dividends, we talk about dividends per share times the number of shares. The number of shares here is the same as the number of shares here, because every shareholder must get a return. So it depends on how many shares. So this number and this should be the same. Now, from this explanation, we can therefore say that since the difference is given like this, we can say now DO or D naught times number of shares is equal to P naught times the number of shares bracket times the percentage, 10%. Because it is 10% of it. So assuming this is the rate, 10% of this will give you dividends. One thing that you can see is common is the number of shares. So therefore we can say that D naught is equal to P naught times, this one is rate. So we can say there's a cost of capital, right? So let's say cost of equity. Cost of equity is the return. Up to there, does it make sense? Cost of equity is the return, which is percentage. So when we cancel number of shares, the number of shares, we're back in a D naught is equal to P naught times KE. Is it okay with you up there? Somebody is not talking. Nobody's talking. Uh-huh. Sally, umepotea wapi? Na Violet, umepotea hapa? Anywhere? Are we still together?
Yes.
Yeah.
Sasa mkinyamaza siwezi jua. Nafaa mnasema. Nasema. Now with this, you can therefore say that P naught is equal to D naught all over KE. Sio bado ni sawa? This one can come here and then this comes here. Now, ordinarily, we can have growth. Did not means that means that is original or the first one. So when you want to invest, you will always go to the bank or the SACCO, then you ask, when was the last interest that was declared? For example, ukienda kwa SACCO kuweka pesa kwa SACCO, the question is always, how much dividend do you normally pay? Hatujui the next one, but tunajua the current one, the last one that was paid. Watakwambia, our SACCO is a good one. Actually, the last AGM, we paid 10%. The last AGM, we paid 10%. So there is always the history of the previous one. History of the previous one is always there. It is the same one that we call the last declared dividend. Now that one you can always know. So you know the amount that you can buy one share. Unamuuliza, so how much do you sell shares? You'll know the price of buying the share. And you'll also know the dividends that was lastly declared. So those are original. But when you buy share now, after 1 year, you might want to sell it. Now that new price will be called P1. The one that you're going to sell it after 1 year will always be called P1. Why? Because it is now after 1 year, but this is the original sahi. Kama time haijaenda as we speak. And as we speak, the dividend that was declared is this. But there is a possibility of growth. You might find that right now, we pay that dividend. Expectation is that the company should give a growth. So therefore, if the company should grow, then the dividends that was declared now or last time should be having some improvement. It should grow so that the next dividend that we shall declare in the next time, which is P1, this now dividends after 1 year should be P plus 1 plus growth. So I want to look at that. The next dividend that we will be declaring is D naught plus growth. D naught plus growth. Up to there, do we have any challenge? Just look at what your understanding is. So, is that now okay? Kuna shida mali. D1 is the dividends after the next 1 year. Now, when I'm investing now, I need to know the current dividend that was declared, plus but any possibility of growth that there will be an improvement in dividends. And your dividends it grow. So if there is any growth, I'll add it here. So that like nobody expect to go down. When you're investing, you expect to have some growth. So if the last dividend was paid, let's say was 10, then the growth can be like another maybe 0.2. Now the next dividend VCD2 should be 10.2%. So that is the rate on return on the dividends. Or if its amount is 10.2 shillings. So that is what we are referring to. So the note should always be lower than after 1 year. The price after 1 year is also P. Okay. So I want us now to look at where there is growth. So we'll say that P is equal to P naught into 1 plus G all over KE minus G. So the amount that I'm paying now, the current price, depends on what was declared plus any growth in the future. So you say where P naught is the current price. This one is the same as market price per share. Market price per share. Market price per share. Then we have D naught, current or last declared dividend. Current or last declared dividend. Then we have G, growth. We have growth rate. And then we have KE, cost of equity. Now, I am repeating. This one is the current price. When I'm going to buy shares, I'll ask, what did you declare last? They will tell you we declare 10%. But for me to buy the shares, I'll ask this 10%, is there any possibility of growth? Yes. So I'll buy because of the expectation in future, and that expectation is D1. So therefore, this one can as well be P naught is equal to D1 all over KE minus growth. Because D1 is basically the same as the D naught into 1 plus G. D naught into 1 plus G. So we can be able to get our cost of equity from here, which we call cost of capital. Cost of capital we can now get from here. We can say that now make KE the subject of the formula. The subject of the formula. So that from here, from here, if we make it, then we are going to have KE minus G is equal to E naught into 1 plus G all over P naught. So you have P naught. Therefore, KE is equal to D naught into 1 plus G all over P naught plus G. This G comes the other side. And why do we minus G? When there is a growth, there is a reduction in cost. There is a reduction in cost. But the dividends go up, the costs go down. So that is why the cost has gone down when the dividend has gone up. The return goes up, the cost goes down. If a company is doing well, the cost of purchase should reduce, but the return should be high. That particular growth reduces the amount of capital that you used. So this growth is like in a percentage. It is a good thing, right? So let's say that I purchase something like 10, but then I got a benefit or a good return, an increment of 2 bob. So that means that my net cost is 8. Because even though I purchased at 10, there is a growth by 2, which is an income. This one was outflow, this one is inflow. So the net effect in percentage is the difference between these two. This is what I've really incurred. Oh, you're not seeing. This is what I've really incurred because this is what the cost should have been. But hii nimepata. It has grown. So the net cost is 8. The same way this one works. That is why KE minus G. And so you can see the formula. That now, we can now say KE is equal to D naught into 1 plus G over PO plus G. This one in here huku juu. So this one is separate. Like this. If it is not clear, I can write for you somewhere. That the cost of equity is equal to DO into 1 plus G all over P naught plus G. That is the formula. That is the gospel truth. So D naught, I told you that D naught plus 1 into G, into 1 plus G, that one is the same as the D1. D1. So, but D1 is equal to D naught into 1 plus G all over no. So therefore, it is okay if you say that KE is equal to D1 all over P naught plus G. This one is also okay. This one is also okay because you are just replacing this one with D naught. Where D naught, you can say that where D naught is the expected dividend or the next dividend. Where D naught is the next dividend. We say that equity is divided into 2. All right? Equity is divided into 2. So we have 2 types of equities. The first one is retained earning and the other one is share capital. Retained earning, you don't go to the market to acquire. But the share capital, you have to go to the market and acquire. If I am running a bank like KCB and I need capital, I will go and send prospectors. I'll go and invite people to come and subscribe. When I do that, I am actually going to incur some cost, just like the way you can go to the market. There are some costs that you can incur, like taxation, transport cost. You could have brokers hapo, they will charge you something. Those are costs that we call flotation cost. The cost that you incur to get to buy shares or to sell. Ukitaka kuuza ng'ombe lazima uongee na mtu. Ukitaka kununua ng'ombe lazima uongee na mtu. So generally kuna cost, brokers are there. But for retail earning, we are not going to the market. Tunaongea na wale directors tuko nao, tunawaambia manze, badala ya kuchukua hii pesa, you can retain it here and get something in return. So retail earning does not have any flotation cost because we are not going to the market. Therefore, we can say that equity is now divided into two. So therefore, the cost of equity can be the first one, KER. That is the cost of retained earning, which is B naught plus 1 plus R RG into P plus G. Then we have KES, that is the cost of ordinary shares, which is D naught into 1 plus G all over P naught minus F plus G. So the difference here is that this one has got a flotation cost. Kama unabuy ng'ombe ama unanunua ng'ombe na ng'ombe ni 20 bob, ni 20,000. On that 20,000, you will take like a small percentage you give broker. So the share price, there is amount that brokers will take or the cost that will incur to sell one share. That is what we less here. So it is the flotation cost. So you say that where KER is the cost of equity, retained earnings. That is why it is R. Well, KS is the cost of share capital, which is also equity. But this one is now share capital. And then we have F. F refers to, we say that F is the flotation cost of selling. This is the flotation cost, which is the cost of selling. Is there any challenge up to there? Check your notes. Just go through your notes. I'm giving you 1 minute. Go through your notes and tell me if you understand what we're doing. If you don't understand, ama kuna mali umepotea, let me know. Start going through your notes from where we started, if it is flowing for you. Tuko sawa? Is there any challenge?
No.
No challenge. Fine. So we have seen the way we have derived the formulas from the normal interest, the way you normally get interest from the principal to this formula now. So the aim was to come here, though we started from interest is equal to the deposit times the rate, whatever. The aim was to come here. Thank you so much. So that is the cost of equity. And we agree that there are two types of equities, retained earnings and also the share capital. We have seen the differences on the formula caused by the flotation cost. And now we know what flotation cost basically means and why it is there, right? Now let's look at the cost of debt. Cost of debt. So we can say that the cost of debt can be called KD. KD, cost of debt. So we are saying that ordinarily, our interest, which is the return, is normally the debt amount times the cost of debt, or the interest rate. Cost of debt is the interest rate. Interest rate times this gives you this, right? So that means that if you bring this over this side, then we normally have KD is equal to interest all over debt, right? But one thing that we remember, the interest that we normally get is after tax. See, interest is normally tax allowable. Interest is normally tax allowable. If you are doing business, you normally expense it. So it means that you are going to pay it to whoever you're going to pay. You're not going to pay tax on interest as a business person. So it is the person that you're going to give that pays tax on it. So because it is tax allowable, we normally get net interest after tax. The person that have received it as an income must pay tax on it. Kwa sababu, the person who paid you did not pay tax on it. Aliallow, just like any other expense. So it was tax allowable. So the bank will consider interest as an expense and deduct it or expense it from their books before taxing. So they will exclude it from tax. Ndio wewe, as the investor who is receiving the interest, you pay tax. So it is your income, you pay tax on it. So whatever you're going to get our return must be this interest less tax. The tax rate that you'll be given. If you are told that the tax rate is 7%, is 3%, then now we're talking about the balance, which is 0.7. So 0.7 times the interest that we get better, that is now what you're going to take home. That is the takeaway. For example, if the total interest amount was 10,000, then what you're going home with, and this one is like 500,000, then what you're going home with will be 0.7 of this. So you're going to have 7,000. That is after paying tax now. 7,000 over 5. Of course, this one that we're learning is a firm, financial management. In financial management, you forget about tax. You know, when you come to taxation, Mr. Wino, our tax teacher will tell you that interest on taxes, there's a way they are normally taxed. Either you pay withholding tax, which will be final, 15% on interest tax. Interest income will be final. If it is for cooperatives, the interest income from other investment, you'll only tax 50% of that, and then you claim the withholding tax. If it is interest from primary societies, the interest will be 5%, withholding tax is 5%, and that is final. Those are laws in Kenya. Those are laws, taxation things in Kenya. We are now talking about a firm which is international. What we are learning here is international, not the laws in Kenya. They have nothing to do with the laws of Kenya. So don't confuse the two. Now, we said that here we are going to have debt. So this debt, also like any other Any other amount that you get from the market, there are brokers. There are brokers. So when you are selling debts, debt certificate is just like a certificate. So you take the certificate to the market and tell them, guys, I'm requesting that you give me loan, what we call now, like for government, they call them bonds. These are bonds, they're easy. So the examiner can use the word bond. Don't confuse. Now it is 2K. Bond is just a long-term debt. 30 years. So, or 10 years. So, what we're saying is that when you go to the market and you need money, you really need money. Naambia chukua hii certificate. So, one value of debt unaweza pata one certificate ya debt is worth 1,000. But because you really need money, unaambia pana sina pesa, leta hata kama ni ngapi? 950. So unaambia discount how much? 5,000. For every certificate that you pick, this one was 1,000, right? Okay, let me talk about 995. So naambia badala ya kuleta 1,000, I'll give you 5 of discount. Ndio upate pesa haraka. Now, when you give 5 of this amount that you are now going to receive, so it means that he will buy the certificate, which is worth 1,000, lakini ile pesa utapata is 995 because ulikuwa na haraka kupata. And that is what happens. Let me tell you, kuna a lot of secret in the government. So you might find that the finance team are negotiating to get loan from China. Lakini kupata loan ni ngumu because of our appraisal rate. When they do our appraisal, wanasema you guys are not worth this amount. They can actually agree to give those people a discount. Of course, hao pia wanakula. So they can give a discount of 10 shillings. 10 shillings. Lakini moja anakula, Kenya anakula 5, Chinese pia 5. Wanachapa deal na hizo banks. So at the end of the day, you guys are only going to receive this amount. But the debt that you're going to pay is this. Because of this amount. So we are realizing that because of discount, we can actually get less. On top of this, there is flotation cost. The brokers, wale walikuconnect na huyo China, kama ni Adani, mwenye alikuconnect na Adani pia anataka kakitu. So Adani ashaelewana na Ministry of Transport na wakasema tukule 50-50. Wewe kula 5, mimi kule 5 for every certificate. For every share certificate. So kama tumechukua loan ya 1 billion, now you multiply with this the number of the value of certificates. For every certificate there is 5. People are making money. Now, on top of this, there is a broker. Mwenye anajua Adani, yeye ndiye alikuintroduce kwa Adani. Na Adani akaleta kitu anataka discount. Huyu mwenye alikuintroduce lazima umlipe kitu. Lazima. Na pia Adani pia atampea kitu. Lakini because unamlipa from the amount that Adani paid you, so this amount you deduct 5 more and then also deduct the one for the broker. At the end of the day, unaenda gapi na unaenda home na gapi? 985. 985. Tuko sawa. So therefore, what we are saying is that the cost of debt can be affected by those two items so that we have cost of debt being equal to interest into 1 plus 1 minus t, or lower debt, which we call market value of debt, MVD. Market value of debt, the total value of debt, minus the flotation cost minus discount. And that is the gospel. That is the gospel. So you can only add and say, where D is discount, where D is equal to discount. MVG is equal to market value of that. F, flotation cost. Flotation cost will be given in terms of percentage. Committee can give you in terms of percentage. It's normally the cost of a one lot. So you don't know percentage of this. Unless they give you the amount. If they don't give you, they give you percentage. Apply. If it is 10%, 10% of this. Discount percentage of this. We shall be able to see how it goes. Let's look at now the cost of preference shares. What is the difference between preference shares and ordinary shares?
Preference shareholders have a fixed dividend rate.
They have a
And they
fixed-
are paid. And they are paid before the ordinary shareholders.
So preference shareholders is like a special of debt. It behaves like debt, it behaves like equity. When you're doing a FAR, you'll be realizing that they are convertible. We have redeemable or convertible. There are such times. One thing that we remember these people is that with them, they are like debt holders. Number one, just like debt holders, you have to pay interest first. These guys also, you have to pay them interest first, preference shares, preference dividend first. They have the right before the ordinary shareholders. Wanakaa kama wenye kampuni na tena sio wenye kampuni. The only difference with them is that with them, you pay them after taxation. After paying tax, that net profit that you want to go home with, hapo ndio sasa unawalipa. And there are two ways again. There are those groups that can agree, you can agree with them, that if you don't have money, you can accumulate. So that if you don't make profit this year, just calculate what you're supposed to pay me, accumulate, so that next year you can also pay me total. Like if next year you make a loss, you also accumulate. That one we call it cumulative dividends. Hawatakuachilia, but hawatakulazimisha ulipe sahihi. They will not force you to pay now, but you will pay and they accumulate. And I calculate to percentage yake anakuambia, if you don't have money now, fine. Mine was supposed to be 1,000 because you can't pay 1,000, fine, accumulate. So we have cumulative dividends. So why we are saying that they have behaviors, they behave like debt holders, because when you promise, you have to pay on that percentage. Just like our colleague has said here, there is that constant figure that you have to pay them. Whether you make profit or not, they will account for it. And does not change, it is fixed, right? For ordinary shareholders, theirs change. If you make profit this year, you pay 15%. You don't make profit next year, you don't even declare anything. Maisha yanaendelea. But the difference between loan holders, how? These guys, with them, you pay them after tax. So you'll tax everything and then you'll now home, now you pay them. So they don't have tax allowance. So cost of preference shares if you call KP, is normally KP is preference dividend just like we were having interest here, we were having interest as the return all over the market value of preference dividends, of preference minus flotation cost minus dividends. So naona ina behave kama loan. Kuna flotation cost na kuna dividends. Alafu hapa for loan we had interest where we say that interest minus tax. This one does not have tax because you're being given after tax. That is how the formula looks like. Then you say that where MVP is equal to market value of preference. Market value of preference share capital. Again, look at that. Check if it makes sense to you to proceed. I want to look at one of the past paper questions to only. So, I want us to look at Zomolo Limited. That is a May, write down May 2019, question number 3B. May 2019, question number 3B. The question says that Zomolo Limited is a firm operating in the manufacturing industry. The firm's current capital structure is given as below. So we have ordinary shares, 10% per value. Reserves is given as well. Reserve is the same as retained earnings. So we have 10% redeemable debentures. Debentures are loans. So the par value for that loan is 30. So how many debentures you can get? Nini is 100 shillings per value. We have 10%, 8% preference shares capital at 20. Additional information, the current market price per share of the firm's ordinary shares is 34.8 come dividend. Come dividend meaning that with dividend iko ndani. Sawa. The price iko na dividend. So if you want to know the price peke yake, unatoa dividends, you'll be able to know P naught. P naught is what? The current market price. So that is P naught. So P naught is given as 34.8 ikiwa na dividend. The firm adopts 60% dividend payout ratio. The most recent earnings per share, of this firm is 8 shillings. That is, what is the earning per share? It is composed of retained. EPS is equal to when you get your money. When you get your money as profit, as you get your money, when you get your money as profit, you'll say that let's say profit before tax, you have something like 100,000 less tax. So maybe 20,000 or 30% of this can be 30,000. You normally have profit after tax, which is 70,000. Then you ask yourself, what was the number of shares that we were having when we brought in the share capital to start the business? And the business is able to generate this. What was the number of shares? So let's say that we had a total of maybe 10,000 shares. So this is now the same as earning after tax, earnings after tax. Now, our earnings per share is now the total earnings. Total earnings all over total number of shares, which is now 70. This is a total earning all over 10. So it will be 7. As you can see, this 7 is derived from this amount, the full amount. We can decide to retain, now this is the earning per share. This earning per share, we can decide to retain part of it, and part of it we pay as dividend. So you can decide and say that 60% of this will be payout. That means that automatically retained earning will be 40% of this retained. Automatically, the other one is retained. So 40% of this will be 2.8, while 60% of this is 4.8. So 4.8 we are paying out, and 2.8 we are retaining. The one that you are paying out is now what we call dividend per share, DPS. So earning per share is divided into two. There is dividend per share and also the retained earnings per share. You either retain ama pay dividends, ama kula yote. You can also have 100% payout. The examiner is telling us that this guy had got a policy. The policy says that the firm adopts a 60% dividend payout ratio. So that means that from whatever income that you get, 60% will be paid. This one is per share. So if you're having dividends per share, you can multiply this as the number of shares and know how much was paid as dividend. Total dividends is equal to dividends per share times the number of shares, which in this case will be 4.8 times 10,000. Of course, that is 48,000, right? Is it? Not 48,000, but 4,800. 4,800. Unaelewa? So that is how it comes. Now, you can go back to the question. So we've been told that they adopt 60% payout. The EPS was 8. The most recent earnings per share. Oh, actually, this one should be 4.2. So 4.2, not 8. 4.2. And then this one now will be the difference. And this is at least 2.8 is okay. So that's 4.2. We are told that the historical dividends per share, dividend that they have been paying over the last 4 years, we can find the last. Remember, we cannot know the dividends that can be paid in the future. Ikiwa tuko hapa sasa, we can't know the dividends that we don't have history of dividends that will be paid in the future. But tunaweza jua mwaka jana tulilipa ngapi, ile ingine mpaka 4 years backward. And as you can see, they're giving us the last, meaning that 2023, 2024, meaning 2023, 2022, really nyuma. Because 2024 haijaisha, we cannot know. So we don't have that history. So that is what they're telling you here, that we can get the history. Now, from here, you can see the immediate one, the last one. We had, the last 4 years, we have 2015, 2016, 2017, 2018. Why are we talking about 2018? Because this question was sent in 2019. And by the time it was being set, 2019 haikuwa imeisha, we could not know the dividends that was paid. So we could only know the history of 2018, 2017, 2016, 2018. Now the recent one that was declared is 4.8. This is the most recent because we are now in 2019. Tukiongea when the paper was set, tulikuwa 2019. And so the last one that was declared was 4.8. So if you are told that the current price was 34.8 come dividends, ikiwa na dividends, that means that that dividends we are referring to is this 4.8. So unatoa 34.8 minus 4.8 ndio ubaki na price free from dividend. How much is the market price without dividends? How much?
30.
30, thank you so much. So you can know your P is 30 because you have seen that the dividend was 34. In fact, hata kama wangesema come dividends, unajua dividends iko hapa ndani, you just come to the last one and then check. If dividend was 30, come and remove that, like that. The firm's management is contemplating to invest in a project which will cost 40 million. The project is expected to generate 9 million each year in perpetuity. The project has an estimated beta of 1.5. The return from a well-diversified market portfolio is 8%. The debentures are considered to be risk-free and are valued at par. The existing 8% redeemable preference shares are currently trading at 25 each. The corporate tax is given as 30%. The first question, the firm's return on equity using Gordon's growth approximation method. I brought this example because of that part, Gordon's growth approximation method. Now, we have somebody called Gordon. This guy has got two formulas. The first one is called growth approximation method. Then we have the normal Gordon's formula. So we will be able to look at them and see which one is okay. And even the one that we're talking about here, this one is also Gordon's formula, but not growth approximation. It is not approximating growth. The one that we're talking about, P is equal to D over KE. That is also Gordon's formula. Sawa. That formula that we have been using here, P is equal to D plus 1. Even this one is Gordon's formula. And you can play with it the way you want. It is also Gordon's formula. And that is why examiner is very specific. And Anakwambia Gordon's growth approximation, so that you know which one is referring to. Because kuna hii pia. Now, the one for growth, according to Gordon, growth can be approximated using different formulas here. Gordon's growth approximation formula or models. The first one, there are two. The first one is that G, which is the growth, is equal to return on investment times the retention ratio. Return on employment or investment times retention ratio. That is the first one. That is the first one. And according to this, RO, you can say RO is now the growth all over retention ratio. Return on equity the same as the return on investment. That is, equity is the amount that you invested. So if we talk about the ROI or ROI, they are basically the same. Return on investment, you are referring to the amount that you injected in the business to invest. Return on equity, it is that equity that you injected in the business to invest. So return on equity and return on investment, in this case, they are more or less the same. I hope that you rated that. This one, return on equity. Now, the second formula for Gordon. Now, we'll choose, depending on the information that you're given, utakuwa unaangalia which one is applicable. The other one that we have, Gordon says that G, which is the growth rate, is equal to, they are saying that G is equal to N into the last declared events or latest events all over old dividends, latest events all over all dividends minus 1, and all these times 100. Some books will call it last declared event or latest. Ile ya mwisho. Yes, sir, if the immediate one. All over all, ile ya kwanza. So some books can call it past or old. The most important thing is that your formula looks like that. This one. Where N is the number of years we are referring to. In fact, it is normally N minus 1, total number of years minus 1, so it is N minus 1. Those are the two formulas that Gordon proposed that you can use to get your growth. These are the growth rate approximation formulas. So now the question is, which one have you been given to get the growth? Why are we having these two formulas? Because you might find that you're not given growth. As you can see, return on employment, examiner says that require return on investment or return on employment. They want ROE. but you don't have G. How do you get G? Use this to get G and then come and replace here. Both of them are for Gordon, and Gordon is telling you, you can get G through this or this. If you're not given G and you need to get RO, come here. Use this to get G, then now substitute. So, can we now proceed? We can now proceed. N is the number of total years that you have, -1. So if you are having there 4 years, then -1 will be 3. Now, because we are told to get ROE, and we have to get it when we have G, we need to get G first. So we are going to use the Gordon's formula to get our G. Then from there, we can now proceed. Let me share the screen. Then you tell me the figures. So our G. So the first thing that we know is that G is equal to N minus 1. All these. Then we have latest or last dividend all over all events, all that -1, then you multiply the 100. Fine. So what is the number of N? N is the number of years in question. So we have how many years for dividend? 1, 2, 3, 4. 2015, 2016, 2017, 2018. So those are 4 years. So in our formula, we come and start by saying 4 minus 1. All these. What is the latest dividend? The one that has been declared more recent. $4.8, and the old one was 4. So we have 4.8 all over 4. All these, we are going to minus 1. So we need to calculate this and minus 1. Then, so when we come to 100. So let's start with this. 4 minus 8. Now, 4.8 divided by 4. What is the answer? So it is like tunapata hii na minus 1 kwanza. Tell me, 4.8 divided by 4 ni ngapi?
1.2.
So we'll have this one is going to be 3 into 1.2. What are you having? Minus 1.
No, 1.2 minus 1 now. Oh, yeah. Okay.
Cube root of this, what are you having? Tunamalizana hii kwanza. Hii ni hapa ndani. Cube root of this, what are you getting? Hii iko bibi yake. Unamalizana hii, the answer that you get, una minus 1, then you proceed there. So get me what you're having. Do you know how to do that? Unafinya 3. Then you come to shift. Una shift hapo. Then you go to that thing that looks like this. Ukifinya hapo utaona inakupea 3 star and then root. Now punch 1.2. It gives you 1.162. Are you seeing?
Yes.
Tuko pamoja?
Yes.
So you're going to have 1.1626 minus 1 now. So you are umemalizana na hii. now minus 1. So remember this one is not inside. Hii iko nje. Unamalizana na hawa kwanza, unatoa. So times 100. What is the percentage? It gives you 6.3%. Sio? Jamani, tuko sambamba? Are we together?
Yes.
Nice. So we have our growth rate. Of course, ukipata growth rate something like 60%, ama upate error, upate 60, 40. You are wrong. Hakuna kampuni inaweza grow at the rate of 60%. Should be around 5, 10, maximum ama 12 kama ni imeenda sana. Chini tu kidogo. You can't grow at umeanza biashara wewe kesho umefika 50%, 60%, pole pole tu. So, we have our G. And we remember, the examiners wanted us to get the return on investment. We are told that get us return on equity, which say that is G all over R. And we now have G. What is R? R is equal to retention ratio. So how much were we told that was declared? How much do they pay as dividend? Ndio tujue wana retain ngapi. We are told these guys have a policy that they adopt a policy that they pay dividend 60% payout ratio. That is 60% payout ratio. What is the retention ratio? So 40%. Because if they are paying 60%, then how much are they paying? Retention. 40. So we can confidently come and say that our ROE is equal now G, which we got to be 6.3% all over 40%. Is 40, 0 point, or 40%, just say 40%. And because all these are percentage will cancel percentage. Ukipata hapa, it will be without percentage, but return should always be in percentage. So you have to put it times 100. Sasa, ukiacha hivi, percentage will cancel percentage. The answer will be without percentage, it will be in decimal. When return should always be 10%, 20%, so it should be times 100. Ndio ikuwe in a percentage. So we have 6.3 times or divided by 40, then times 100. 15.75 is your answer. Percent. And you understanding, are we not understanding what is happening? Are we understanding what we're doing? So that one, you have gotten the first part of the question. It looks very simple. So how many marks was that? 3 marks. That is why. Then the second question is now the firm's existing weighted average cost of capital. The existing weighted average cost of capital. So on this, when you are told about weighted average cost of capital, weighted average cost of capital, that is WACC. Work is normally, can somebody give me the formula for work? KE times the weight of equity times cost of equity plus weight of debt times cost of debt minus 100 minus T plus. So if you consider the cost of debt to be the rate of interest before you remove debt, it is the rate of interest minus tax plus the cost of weight of preference shares, that is WP times the cost of preference shares. That is now weighted. Anything that is weighted is weight times that one. Like now we did yesterday, weighted better. So we have to put all these sources of capital. Now let's now get the cost, the weights. Cost we shall also work on and then get our work. So work requires us to work on weight, work on cost for each. Let's now determine weight. Determination of weight. So we have that. So the first one, we are told sources of capital here. We have different sources of, these are the capital that we're going to weigh. Always leave out retained earnings, reserves. Andika mahali, always when you are weighing, when you are getting the weights, always ignore the weight of reserves. Because the reserves ni kama ordinary shares, they are not different. So weight of ordinary share is the weight of reserves. So you don't consider it. Now, what you now do here, we have source of capital. Then we have our market value. Convert it to market value. Get weight with the market value. Sasa, in fact, you need to know the current market value. You know, this one is the book value. So we have book value and then market value. So let me do that for you. Whatever is being reported here is normally called book value. This is how they are in the financial statement. So it's called book value. And now you calculate market value. And then you calculate the weight. Weight is normally from the market value, not book value. Are we together? The weight is normally from the market value, not book value. So you have the source of capital. And the first one that you're given there is ordinary share capital. So you'll have your ordinary share capital. Ordinary share capital. What is the book value? The book value that you're given is the one that is here. Right? 80. But this 80 has got how many shares? We can get the number of shares. The par value, for us to get 80, each was 10 shillings. So how many shares? Divide the book value with the number of, the amount per share to get the number of shares. What we are saying, we had a certain number of shares. When you multiply that certain number of shares, which is called X times 10 is giving you 80. So what is the value of X? It is now 80 minus 80 divided by 10. So number of shares, will be, hata niweka hiyo column. Wacha niweke hii kwa vizuri. Number of shares. So we have our book value. Then we have number of shares. Then we have our market value. And then we have our weight. Can somebody get us the number of shares? Number of shares on ordinary share. So are you seeing now? So we need to know the book value was 80,000. Number of shares, you divide the book value with the par value. So 80 divided by 10 is giving you 8,000. Are you seeing? Now, our market value, you now get market value per share times the number of shares now. So the market value for ordinary shares is ngapi? Market value, we are told that the firms, the current market value, MPS iko. We are told that the current market price per share of the firm's ordinary shares, for the ordinary shares, is 34.8 come dividend. So remove dividends in inabaki 30. So it is 30. So it is now 30 times 8, or times 8,000. What is our market value? 24,000. Is it 24 or 820? 240. 240,000. That is how you get the market value. So first, look at we want to wait. We want to get the weight. Look at the book value. Use that book value, divide it by the par value to get the number of shares, multiply the number of shares to get that. We say that you ignore reserve. So reserve, even though it is there, reserve is how much? Reserve is 20. So the book value says is 20, but we don't get the number of shares. Ignore, and even the market value, ignore, the weight, ignore. The next one that we're now having is 10% redeemable debenture. So you write there 10%. You need to clearly show which one you are referring to, because you can have different debentures. A redeemable debenture. And what is the value? Now the other one was 8% preference shares. Preference shares. So again, we can get our book value. The book value are 30 and 20. This one is 10%, 100. This one is 20. So 30 and 20. 30,000. Here, 20,000. When we count number of shares or number of certificates, we are going to get our 30 here, the 30 divided by 100, 100 gives you 300. Sindio? Do we have a market value? So that is 300 certificates. Do you have market value for debenture? They say that debentures, number 8, debentures are considered to be risk-free and are valued at par. So that means that the value of debenture, which was 100, is still 100. So it is still valued at par. In the market as we speak, the debentures are risk-free and therefore they are valued at par. The price has not changed. If it is risky, the price can change. This one does not change because it is risk-free. So it is divided, is at par. So you take your 300 times 100 and you get your 30,000. The price has not changed. Tuko pamoja? This one we are told 20. So you divide 20 by 20,000 by 20. So we have here a total of 1,000. Are they trading at a different price from this? You read, go back to the question. What is the prevailing price in the market for preference shares? We are told the existing 8% redeemable preference shares are currently trading at 25. Originally it was 20. It is now trading at 25. So we have seen the number of shares multiply with 25. So what is the value? So it is 1,000 times 1,000 times 25, which is 25,000. So these are the values. Anything else? Nothing. So this is the total market value. I told you reserves always leave out. So our total is now add and get the total. Here will be looks like 295. 295 is the total.
Yes.
Now the weight is now 295 all over this. So it is 240 divided by 295. We have 30 divided by 295. Then we have 25 divided by 295. What are our weights? What are the weights? So you can have them, you round off, so you have 0.81. Can all talk like that? So that we have total of 1.00. Those are the weights. It should add up to 1 opportunity. So now, We have calculated our weights for each. Now come to the cost. And that is what we were learning, the cost of capital. That is what they were testing with that example. So the weight of equity is equal to, no, or maybe to sharp part, cost of equity is equal to, we say that is dividend. Who can remind me the formula that we're using? Is DO? Cost of equity is DO into do you have production cost? We don't have, Cindy. We didn't mention any flotation cost. So we will ignore this. So this one is equity for S, the ordinary shares. Therefore, this one, we can have our dividend. Which dividend are we using? The last declared dividend. Which one is that? The last declared dividend was 4.8, the last one. That is not. So 4.8. The growth do we have? Tumepewa growth rate. Growth rate to calculate, ndio 6.3. We are calculated. What else are we not having? Hapo P naught is the current price, which is 30. So we are good. We are good. So just have now replace this one with 4.8 into 1 plus 6.3, which we have calculated. Or we can now have it in percentage. This one is now 0.6063 all over 30. If you calculate this, what are you having? Plus 0.3. Is dividend is this dividend in percentage or the dividend is in shillings? The dividend is in shillings.
Shillings.
So then we have our G 0.063. After calculating this, you have this. So we need to have this. Then we add our G. That is how the formula looks like. Now this one is a bigger bracket. Tell me what you're having now. So 1.1 plus this divide multiply. What are you getting? So you have 4.8 times 1.063. You're going to have 5.1 divided by 30. Then you add 0.063. We are having 0.23. 0.233 times now 100, because it needs to be in percentage. The cost must be percentage. So we're getting 3.3%. Now let's come to the cost of, which cost again are we calculating? Cost of debt, right? What was the formula for cost of debt? Interest into 1 minus T all over market value for debt. Do we have F and D discount? We don't. So we come here, calculate our interest. What is the amount of interest that we are having here? We are told that the rate was 10% of this. So 10% of 30, what are we having? And now we can be working with it per share. So instead of looking at it from the total number of debts, we can get per debt, because even there we're getting dividends per share. So we get per value. So 10% of the value. What was the interest that we're going to get? The interest per debenture. One debenture you get to pay interest how much? So it is 10% of this. So the par value of one debenture. And even here you use only value for one debenture. So here is one for one debenture. It is 10%, that is interest times 100. 100 is the value for one debenture, which we shall have here. Then we have 1 minus 30% was the interest rate, so it is 1 minus 0.3 all over 100, because 100 is the value of debenture. Ukiamua kuweka in total, then you have to put all of them in total. Make this one be 30,000, this also 30,000. Ukiamua per value, so that will be total debenture. Total debenture is 30,000. So interest is 10% of 30. Then the value here 30. They cancel each other anyway. So therefore, from here, we can see that this one is the interest rate. The value cancel value. So tumebaki na 10% of 1 minus 30%, which is 1 minus t. From here, we can simply say that therefore KD is basically the interest rate, which is 10% times 1 minus t. So instead of getting the values, next time you can just have interest rate, which you are given, that's 1 minus t, that is KD. So you can be able now to work out, because this cancel each other. The rate you're given as 30%, so that is basically 0.7, right? So you're going to have here 10% times 0.7. Get me the figure. Next time you can just take the interest rate direct without calculating the value, because you can see the effect is 0. So what were you saying? That KD is unapata KD ni ngapi? 7%, sio? So tumepata KD, tumepata KES. Which one again are we now looking at? The cost of preference shares. So hapana nanyandika tu cost of capital. Cost of capital. Let's now get the cost of preference shares. We say that it is the preference dividend all over market value of preference minus F minus D. Now tuna hizi mbili, so we just need to know the preference dividend. So we need to calculate preference dividend. So cost of preference dividends is equal to return preference dividends ni ngapi? So it is dividend per share. So we can have this per share and also this one per share. So that is dividend per share and also this one dividend per share and also market value per share. Market value per share, preference per share. Because now this one is not there, these two. Those ones are not there. So we have dividend per share is how much? One share was 20 bob. So dividend per share is now 8% of 20. One share was 20 bob, 8% of 20. That is now what you need to have there. And then all over the market value is now 25. So we have 8% times the value of one share all over the market value of one share. So that comes to any question? So we can now get to work. See you. So this one will have KD direct because to share malizana and tax, we just put the KD. Get me the answer. What is the figure?
$6.379.
6.379. So that is 6.3. Is it the same as 6.4 now? Are you sure? Because hii peke yake ni 6.4. So 6.379 ni kama 6.4. Umefanya calculation vizuri? I don't think it's true.
9.33. No.
Hii peke yake ni 5.1. Hapo hii ni 7. What was this one? This was 6.3 or it was 23.3. You guys, are we really following? Ni kama mna copy tu. Mwezi niambia, this was 23.3. Alafu hii ya pili 7 na ingine ni 6.4. So that is okay. So it is 23.3 times 0.81. Let's not just copy, let's follow. Let's follow what we are doing, ask questions so that you don't just copy. We shall get one answers here na mmenyamaza tu. So what are you guys getting? 7 times this, nakuja ngapi?
I'm getting 20.149. 7 times that is 0.7.
Yes. Hii iko sawa, sio? So we have 0.7 plus 2.576 plus 18.873. Something like that, eh? So that is what the examiner wanted you to calculate. You can't do it without getting the weights. So you can see that there is a way, the first questions which was helping us to get the growth, we have used that growth somewhere to help us get all this. The cost of equity, we use growth to get the cost of equity. Kwa hivyo, question number 1 is always linked to question number 2, Roman 1, Roman 2, they are always linked. If you get one wrong, you might get the whole thing wrong. Let's look at the last question on that same one, last Roman. They were saying that, do what? Alafu we close, eh? I think leo tumefanya a lot. They are saying that projects risk adjusted discount rate. You remember this? RAD. Risk adjusted discount rate. Risk adjusted discount rate. So how do we get risk adjusted discount rate? Can somebody tell me the formula? From your notes, we said that use CAPM to calculate this. CAPM risk adjusted discount rate. The formula is always use CAPM. So RAD is always equal to RF plus ERM minus RF into beta. Did you see some beta somewhere? You saw beta, right? Why do you think examiner gave you? Amekwambia, the return from a well-diversified market portfolio is this. The project beta is 150. So the examiner gave you that because they knew you'll use it. So we come here, oh, return is it 14%? 1.5, and then return from 18. Risk rate is given. Risk rate is given still. Wamesema debenture is risk rate, so we use the rate for debenture, which is 8%. Is it debenture or preference shares? No, debenture. The debentures are considered to be risk rate. So the rate of debenture, which is 10%, is now the risk rate that we shall use. So our RF is 10%. Umeona vile amekupea hiyo? So 10% is the RF because debenture is the risk rate and the rate on debenture is 10%. Plus 18 minus 10 into 1.5. Is it difficult? Huh? E times this, that's 2. 2 times this is 11%. Is it? Ama napata vitu zangu. Confirm. This one times this 8. 8 times this 1.5 times 8, not 3. 12. 12 plus this 22.
22.
So the answer is 22. Man. So this one is 12. That is what examiner wanted you to do. Lakini ameficha hii. That is the only problem you have. So you have to be very keen. Kwa makini sana ukisoma maswali. See, tumemaliza. Aya, see, if I say good night, I can be okay. Any question, any challenge? I'm very happy that tumemaliza hiyo vizuri. Sasa hii Zikunze manufacturing, this one you can try on your own. Or EBIT, EPS, earning per share. That one you can try later. Wacha tuendelee na syllabus. Tusukume syllabus kidogo. Any question? Are you happy? Are you sad? Are you scared? So I can only wish you good night, guys. Thank you so much for coming to class, being available. All this session is more than 2 hours when we are just here. So thank you so much. Have a good night.
Mwalimu,
Yes.
before you go, there's that question you gave us yesterday, April of 2023, question 3C. I kind of got confused.
It was 2023?
April, question 3C.
April 2023, question 3C.
Yes. Part 2 of it was asking about CAPEM. I was getting some funny figures, and I don't think they're there. Can you guide us through it kindly? Part 2.
April 2023, question was 3C. So let me look at it then share on WhatsApp. Because I'm also exhausted. I've been having class throughout the day from Sanani. So let me have a look at it and then share what you have on WhatsApp. I'll be able to guide you. Sasa.
All right.
Thank you.
Good night.
Good night.